Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Today we're joined by Lucas Porbeau from Lonsec. He's an investment guru that works at Lonsec, looking after all things about the market, an economist. So we've got a few questions to run through with Lucas about what's happening in the world, the share markets, and investment portfolios across the board. So thanks for joining us today, Lucas. I suppose I want to get an understanding from you about where we are in the markets. It's been a fairly interesting year, might be one way to describe it, with a fair bit of volatility, interest rate movements, etc. Talk of a second GFC. From your perspective, where you see the markets and where are they headed?
Yes, absolutely. And thank you for having me. And in terms of the markets, it has been, as no doubt your clients would know, pretty volatile. And the main topic really over the last sort of 6 to 9 months has been inflation. So that has been the main thing that has changed from, let's say, 12 to 24 months ago. You know, if we roll back 12 months ago and beyond, you know, the challenge was, how do we get inflation? You know, central banks were trying to stimulate inflation. We had record low interest rates. We had ample liquidity in markets in terms of central banks supporting markets with liquidity. Now that has quickly turned around, and we've seen inflation rear its head, and that's been the culmination of a couple of things. First, we had COVID. We had supply chains effectively breaking down, so the ability for businesses to move goods and services around the world, I mean, effectively that all broke down as we know. So that pushed the prices up for everything. Coupled with that, then we had a conflict, and we do have a conflict, obviously, in Ukraine. And Ukraine is actually a key supplier of agricultural products into the market. Interesting stat, I think, off the top of my head, is about 20% of the world's calories actually come from Ukraine and Russia. So that has put pressure on commodities, including agricultural products, but also things like oil. And then obviously there's been a lot of just stimulus over the years in terms of supporting the economy as well. So there's been a culmination of a whole bunch of things which has effectively put inflation up. And the reason markets have been volatile is, if you think about it, most asset prices are priced off a risk-free rate, you know, be that the cash rate or 10-year bond yield, 10-year bonds. And as you see interest rates go up, the settings in terms of things like 10-year bonds, that changes up. So we've seen bond yields go up from effectively, you know, zero to negative zero in some instances, but we've seen that go up quite aggressively. So if you look at bond yields today, for 10 years in the US, you're sort of around close to the 4% mark. Aussie is similar. So that dynamic has really changed. So how assets are trying to price that in is really why we've had that volatility. So markets don't like uncertainty, and what the market is trying to grapple with at the moment is to say, well, how far will inflation go, and how far will interest rates go up? And that's why you're seeing this month to month at the moment. Like, you know, 1 month it's like inflation's peaked. We'll probably sort of maybe start seeing change in central bank policy through to, you know, following month inflation's back. You know, it hasn't subsided, and so on and so forth. So that has really been the primary thing that's been, you know, influencing markets over recent times, and certainly been one of the big things we've been thinking about from an investment perspective in terms of what it means for asset classes, for valuation. So are asset classes looking expensive or cheap, and all of those sort of things.
Yeah, okay. So what you're kind of saying there is that, I'm trying to figure out best, like, say Woolworths might be valued at 15 times excellent as a risk-free return rate, but risk-free return rate's gone up by 2 or 3%, even though Woolworths might be making the same profit, the same earnings, that kind of stuff, the valuation method has changed and it values less because the risk-free rate's adjusted. The actual quality of Woolworths and sometimes the profits or the revenue margins haven't changed, but the way that it's valued has changed because of what's happening in the broader market.
Yeah, that's right. In sort of conceptually, that's right. And there's some asset classes and some companies that are going to be much more sensitive to movements in bond yields and interest rates. And so asset classes like property, for example, bonds, and then to your point, there are specific companies. Certainly, we've seen a lot of more of the what we would call the growth companies. So if you think about, some of the tech companies, for example, you've seen them reprice back because they are more sensitive to those movements in bond yields and interest rates. So that is why we are seeing more volatility. Interestingly, from a bottom-up perspective in terms of companies themselves, if we sort of look at the last reporting season, it was okay. But there are challenges, we think, going forward. And, speaking to some of our analysts, one of the interesting things is being able to find people, basically, to work. And that has been a consistent theme across industry, irrespective of, the type of business you're operating. That remains an issue. So costs are going up as well, employment costs, all of that is still real. And we're probably yet to see, if you think about the interest rate cycle in Australia, with the RBA has been notching up rates, but the impact of that, to see the impact of that, it probably takes about 12 months, The consumer, if you think about the consumer, over COVID savings levels went up. So people are, in this sort of period, there's still, you can eat into your savings and you can sort of eat into, say, credit card debt or whatever it is. But at some point, if we see, cost of living go up, you will see demand, we think, gradually sort of plateau out, which is what the RBA wants. But when we're yet to see that, and even with mortgage rates, a lot of people have fixed rates. As those roll off and you reset to those higher rates, that's going to have an interesting impact as well on things as well. So I think all in all, look, the next sort of, I think what it all means is that if you think about the market, let's say, a year ago and beyond, it was, in a way, it was a much more easier environment because you had record low interest rates, you had central banks effectively supporting growth assets in many respects. So the decision just to invest in equities, go long equities, was a fairly easy one, and everything went up. Whereas I think where we're heading into is a market of potentially on an aggregate level, lower absolute returns, more volatility, but I'd argue more maybe normal levels of volatility. But at the same time, a lot more dispersion between performance between sectors, but also performance between individual companies. So it's not going to be just what it maybe was over the last 3 years where you just throw your money into any equity and it all goes up. There's going to be a lot more dispersion, which does mean while there'll be losers, there'll be definitely winners. And we think there'll be a lot of opportunity as well because in an environment where everything's going up, that's sometimes challenging as well because, you've got quality companies that go up, but then you've got poor quality companies that go up as well. It's companies with high levels of debt, companies with questionable earnings profiles. Whereas I think the environment going forward will be much more of, the good will continue to be good, but some of those poorer companies will get will be left behind. So what it means in terms of, being able to sort of really analyze, understand, and get an appreciation of, and which are the companies that you think are going to do well in the future, and which are the ones that are going to be left behind. That's going to be much more important maybe than it has been in the past. So with volatility comes opportunity, and I think that is real. And then some assets that historically have again been trading at really high prices. Some of them are starting to pull back a bit at the moment, so that's also creating pockets of opportunity. So it's a two-way streak in terms of volatility, but that's sort of overall what we're sort of seeing at the moment in terms of markets.
Good. I think a good little reminder in there for everyone, even ourselves and the clients we work with, that let's say the share market returns 0% over a 12-month period. That doesn't mean everyone's portfolio and every single stock's done 0% return. The certain indices will have done well, certain stocks will have done well, and with the right investment philosophy, the right investment management, someone's portfolio can still make 5 or 6% in that year because they're investing in the sectors that have made 5 or 6%, when others might be minus 5 or 10%. So I think often people might see the headline share market down 3%, but that doesn't mean necessarily their portfolio is down 3%. And it sounds like that's going to be more evident in the next 12 months.
I think that's right. I think there's going to be, just a lot of dispersion between the winners and the losers.
Something I picked up on earlier, you talk about risk and opportunity markets, and of course you mentioned some geopolitical uncertainties, particularly in the case of Russia-Ukraine war. You got Putin out there making all sorts of threats about what he's going to do and going nuclear, and some things that obviously makes investment markets gyrate. I guess because you did mention there's risk but also opportunities, I wouldn't mind hearing your thoughts on what risks there are. I think you've spoken to that a little bit, but also what opportunities there are. Just in my mind, there's the one that came to my mind recently was Woodside Energy, which is an Australian company, recently signed a deal with a European company called Uniper Global Commodities to supply LNG to Europe. So I'm just wondering whether you can see any opportunities for any other industries or companies in this.
Yeah, I mean, I think. So yeah, there's a bit there, but I think there's certainly going to be like tactical opportunities. So if you think about the conflict in the Ukraine and obviously the energy issues that Europe is having on the back of that in terms of energy supply, there has been a sort of recalibration of every country's had to over there has had to recalibrate or secure energy, which is still the case. So we have seen more broadly some of the commodity plays, companies that have got that exposure do reasonably well because obviously demand has gone up and supply. So, but I think in terms of opportunities, like I think if I was sort of to really sort of take a bigger step back and sort of at a high level, I think. I do think some parts of the market have been oversold. So when you see, this whole sort of, if you look at the data over the last sort of 6 months or so, or 12 months, and you look at, the overall performance of the share market, and so what has done well and what hasn't done well, and it's been a really interesting dynamic in terms of it's been such a narrow market in terms of what's done well, and what's done well are resources and energy. Effectively, on a broader sector level, anything outside of that, you've probably lagged, right? So unless you sort of tilted your whole portfolio to that narrow part of the market, you've probably underperformed, right? But what that also tells you is that for that part of the market that's underperformed, it's just been wholesale selling. So I referenced the tech sector in the past, right? So there's no doubt about it. Over the last several years, you've had tech companies that have only existed because there's cheap debt, right? Now that's done. That's finished. But conversely, there's quality companies, your larger companies in the market, that if anything, they're probably going to get stronger, right? Because in these environments, you tend to see some of the bigger guys, gobble up some of the smaller ones, and if anything, strengthen the position. So I think there's areas. I think it's always interesting to look at those parts of the market that have been just holus bolus sold off, because within that there's going to be winners and losers. On an asset class level, probably the key one I'll sort of call out, which is probably not the most exciting part of the market, but if you think about bonds, government bonds generally, the consensus view over the last several years has been, well, why would you invest in bonds? Because you're getting no return. Bond yields are zero or close to zero. Why would you go there? Roll forward today, and bond yields, again, depending on the day, but you're sort of hovering in the high threes, early fours. That's a very different dynamic go forward. So certainly our view would be that bonds are, traditional bonds, government bonds, are far more attractive today. Yes, they've been volatile because we're transitioning from low inflation to high inflation. But if you roll forward and think about, okay, well, if you're going to get 4% roughly, give or take, that's a different proposition from zero. And then, then you've got to see from a relative perspective, what are you going to get from equities and so forth. So I think this is sort of recalibrating things, and, certain parts of the market, which, were easy to say, I'm not going to even look at it because it doesn't look attractive, and now sort of coming up. Even interestingly, looking at TD rates, and you guys will be sort of close to this. There's some institutions now you're getting a pretty decent rates at the moment. So it just means a whole recalibration of where the opportunities are, and it may be the case that some of those defensive assets are now starting to look a lot more attractive.
Probably just for me, just to circle back a little bit onto on inflation a little bit, just picking up on, people have fixed their mortgages. Me personally, mine runs at end of next year, and then people on the 3-year period that they managed to scrape together last year or something, plus combined with, people have come out of, COVID with a little bit more cash in hand, and they're wanting to travel now. So, as you've mentioned, that, we may see inflation be stable at the higher rates for a longer period of time because of this. Is this also, is it just going to be extended even more than what the RBA expects to happen?
Yeah, I mean, interestingly, the last rate move probably surprised the market. I think the market was sort of looking at 50 basis points, and obviously we didn't get that. So, I mean, there is some evidence that demand is slowing. It's not uniform, and it's not across every sector. I mean, certainly things like, the building construction sector, we are seeing that slow down. I mean, you look at, house prices along in major sort of centres, and, you've definitely seen a plateauing out and demand drop off. I think the interesting thing is employment. So that's this one thing that, because at the moment, because the job market is so tight, there is still sort of a view that, well, if I quit my job, I'll get another one, or if I lose my job, I'll just go into another one. I'll probably get paid more as well, right? So that is probably still there today. But as you see interest rates move up, the market become potentially more challenging, and you might see that if you get that dynamic, that labour dynamic sort of normalise a bit. I think once people sort of get, see, at the moment, people don't have that sense that, there's any job risk.
Job security.
At some point, and it's not going to happen over the next 3 months, but certainly over a 12-month period, that dynamic may change. And so as I said, it takes a while for this to filter through. But our view is, look, in terms of the interest rates, the RBA and to be honest, most of the central banks around the globe, they just need, pardon me, they just want to see evidence of inflation, peaking. And we wouldn't be surprised if you get, within the next 6 to 12 months, you might see a moderation in rates, because the challenge is there is a balancing act between just going too hard on rates and then effectively killing the economy, and managing inflation. So it is a fine balancing act, but it's also a very blunt tool, because some of the, as I mentioned earlier, one of the factors that's contributed are the supply chain issues. Now, some of those, certainly what we're seeing in the data is they're still there, the issues, but they are improving. So if you look at things like movement of goods, how long it takes, delivery times, all of those there's all a bunch of indicators. They are starting to improve. So the culmination of rising rates and some of those supply chain issues unclogging. The X factor, if I was to think of what's the black swan event, so to speak. And it is some of this geopolitical risk, which is hard to, it's very difficult to predict. But I think you just have to manage for it as new information comes through, and what implications anything like that does have on the economy. So if you, for example, if you see large economies like Germany, for example, their energy supplies compromised to a degree where they might need to slow down production in order to secure heating in winter for households. That has implications. But and those things may prolong some of those inflationary pressures. But all in all, I think there is some evidence that you're seeing a bit of things cool down a little bit.
Wayne, I have some questions, I suppose, around that recession interest rate stuff, and maybe I'll piggyback into recession there and interest rates, because obviously they go hand in hand. In that, and a conversation I was having with a client last week about the market prices in information, that wait for information. They and we saw that with the last interest rate rise not doing as much. But there's talks about maybe Australia will be protected from a recession. The US may head into one because of how aggressive they're being over there. Obviously, it's a big, scary word, recession. Obviously, there's lots of history of recession. Is it as scary as it may sound? And if we technically hit a recession, does that mean the market's going to fall another 20%, or is that likely factored in? Thoughts around the big R word?
No, you're absolutely right. So markets, try to price in ahead of time. If you do, by the time you hit a recession, the market's already priced it in. It's interesting. Like when I've looked at this on a global level, but previous recessions and so markets do fall. They tend to fall just before, as I say, they're already priced it in, right? So you get the fall, but then typically then you get a very strong rally on recovery. So Australia is quite fortunate in a way in that the structure of our economy. So if you think about, obviously we're heavy on commodities and resources and so forth. So the structure of our economy is pretty. It's been positive for in this environment. Our base case at the moment is that from an Australian perspective, we wouldn't expect a deep recession. That's not our base case. But to your point, the market will have priced that in ahead of time. and this is one of the, that's why we're seeing volatility at the moment. Obviously, it's inflation related, but it's also, what does that mean for growth and so forth. I mean, from a bottom up perspective, yes, we do think earnings more broadly across the market are going to be more challenged than they maybe were in the past. But yeah, it's not all. If it was a very deep recession, then I think that's a different thing. But we're not seeing that at the moment from an Aussie perspective.
And what is it that makes you think that Australia won't be in a deep recession? Is it because of our commodities trade or anything in particular that you point to?
Yeah, I think overall, in terms of the economic growth piece, like yes, housing is a big part of the economy, but then, as I said, we've got some other parts, and notably things like resources and commodities, which are probably going to do okay in terms of from an economic and revenue from a national perspective. So, and our inflationary sort of figures, while yes, they've been accelerating, they haven't been as pronounced as other parts of the world. We don't have some of the challenges, for example, Europe in terms of energy security, which could have a big impact in terms of economic growth, for example. So I think it's a relative game, and I think we're just on a relative perspective, probably in a stronger position than some other parts of the world.
I think it was only recently, actually, that the new Labor government brokered some sort of deal to supply gas to at least the eastern seaboard, I believe, from our reserves, which wasn't in the past always the case. The companies could sell off the gas to whoever they wanted, but there's now some sort of mechanism that they can flick a switch and say, no, you must sell it to the local industries, for example, so that we can keep producing goods in Australia.
Yeah, no, it's interesting. I mean, look, it's a fascinating debate now, and it's really, I mean, it has really highlighted this conflict in terms of the importance of energy security and food security and so forth.
Another question I have is in regards to interest rates. I know you mentioned a little bit about that before, but I look at what economists are saying a lot. Most economists usually agree or thereabouts, but they have different opinions on where interest rates are headed. Some economists are saying that they'll peak at the end of this year at maybe the high 2% as a cash rate. Some are saying by mid next year we're up around 3.5%, and then others are even saying that potentially we're dropping interest rates by the end of next year. So I'm just interested to know whether Lonsec have a base case on what.
I mean, we sort of go by, look, what is the bond market pricing in, right? So it's probably fair to say that the bond market's priced in a lot more aggressive hikes, but with the most recent RBA announcement, that sort of recalibrated a bit in terms of what the expectation is. So, if I was to pick a number, I mean, I think more broadly our view is that there's a sense, and this is pretty consistent in terms of most of the central banks, that the view is that they're just going to try to go hard and quick in terms of the rate rises. But then, as I mentioned previously, I think in the next sort of 12 months or so, would it be surprising if you start then seeing that pull back? I think we're likely to see inflation remain more elevated, so it would peak out, but it won't go back down to where it was, but it will remain more elevated. But as I mentioned before, there is evidence that the interest rates are starting to have an impact on things like demand and so forth. So are we at peak? I don't think we're there yet, but I think we're getting close. Because some of the data suggesting that by the time you see the inflation data start rolling through as lower, it's already happened. It's a bit of a lagging indicator.
And I do know we're starting to receive some monthly data now as of, I think it was last month, that we're starting a monthly inflation data come through from the ABS, although that's not the official figure. That's, if you go to the RBA website, that's not what's on there. I did note that was up around 7%, so a bit higher than the 6.1 that the RBA is currently stating, but starting to get a little bit more free flow of information. So it'll be interesting to see where that goes.
Mm-hmm.
I'm also interested, because you mentioned demand there and the interest rates are having impact on demand. You also mentioned earlier on about households who have fixed rates potentially coming off within the next year or two, and then they'll get that real big jump from a pretty low fixed rate to 4 or 5% or whatever their variable rate at their bank would be. Something I come across the other day was a stat sort of comparing Australia's fixed rates to the US. Now, in the US, a very different system. They can fix rates for 30 years. And the stat was that something like 15% of households in the US are on a variable rate, okay? And the rest of them are fixed, whereas in Australia, it's very, very different, because we can't fix for that long. And so with our Reserve Bank putting up rates, it can have a much bigger impact on household spending as opposed to the US. So I'm just wondering what your view is in terms of how far, say, the US might have to push as opposed to Australia, because the US Reserve Bank seems to want to almost send their country in a recession. That's almost what it seems like. How fast they're increasing rates, and also what that does as a supplementary to differences in exchange rates in terms of how that can affect other countries like Australia.
Yeah, so you're right. The variable fixed dynamic is very different. So Australia is much more sensitive, to the interest rate. No, the households are much more sensitive to the interest rate cycle, given the high percentage of variable rates, so 100%. I think in the US, one of the differences is you've seen that core inflation figure go up as well. So it's probably fair to say that the inflationary pressures are much, certainly stronger, I'd say, compared to Australia in terms of where we're at the moment. But you have definitely seen a strengthening dollar, US dollar on the back of that as well. So, the implications are, it depends on the economy. Certainly on the emerging market economies, they're much more sensitive to that, and that's going to probably hurt them more in terms of the rising dollar. I mean, the Aussie dollar's been depreciating, obviously, over the last sort of period as well. So, I think I think the main point is, there's, if you sort of break down the world, there's probably different sort of contributors to inflation, different levels of inflation that you probably see in different ways central banks will respond. But certainly if you look at the Fed, I think that the narrative is much more that if a recession happens, so be it. I think they're very much on that sort of, we're just going to keep on going until we see we sort of see that slow down. So, but in Australia, it's yes, we are, as I mentioned before, we're seeing the similar pressures, but it's probably not to the same extent as some parts overseas that we're seeing. But the interest rates, look, the variable interest rates in terms of households, if anything, that's going to have a bigger impact here and slow down demand quicker because people are going to feel it.
Arguably, the US Fed, in my mind, has to push rates a bit higher because the impact of the rate rises maybe aren't flowing through like they would in Australia because households are mostly fixed.
Yeah. Yeah, it's a different, absolutely, it's a different construct. Yeah.
So the Optus data breach is top of everyone's minds, that, well, especially those that are Optus customers. So do we, myself included, is there going to be potential impacts and flow-ons to other companies in the future, and Telstra, banking, how are they going to deal with this? What are, are they going to be investing more into their capabilities, or is we going to see a removal of data being provided to these organizations? Or
look, it's a I'm not an expert on cybersecurity, but just if I sort of think about the last sort of 2 years, particularly when everyone's been working from home, cybersecurity has been the incidence of cyber, cyber breaches is sort of amplified for a whole variety of reasons. So I think what I would sort of say is that companies are spending, and I don't have the stats on this, but I know they are spending a lot more money and resources in terms of cybersecurity, a lot more than they maybe did, say 2-3 years ago. That's just the reality, because the risks and the number of incidents it's just gone up substantially. That's sort of the only sort of tangible thing I would say, is that businesses effectively ramping up, however they can protect data and avoid any leaks. That is absolutely true.
Yeah, because the risks have increased substantially since everyone's been working from home and continue to work from home. So which makes sense. Would it be investing in those cybersecurity firms? Would it be a long-term decision, or it's just a short-term? Hey, we've got this thing, sort it out, and then it's.
I mean, it's also I think related to the comment we had previously is how much of that's already priced in. By the time some things become a sort of a big thematic is, so is it going to be relevant over the coming years, and what, absolutely. But but I guess from an investor perspective, you're thinking about it from a okay, well. And I haven't looked at the data, but I'd imagine that by the time it's in the papers, there's a lot of people who've already looked at all those companies and stocks, and what are they trading at? That's the important thing you've got to look at. But as a broader thematic, absolutely, it's not going away.
So we get a few questions from clients lately around, the performance of their investment portfolios. That, for us, most of them are in retirement mode. So they've dropped, substantial amounts, $60,000, for example, in the last 6 or so months. So I suppose the question to you and the response back to them is why should I not really care about this? Should I move it to more of a defensive position now, or again, like we try and always do with clients, is just hold fast, hold steady, believe in our investment philosophy, and just ride the wave, or ride the fun for the next few years at least.
Yeah. Well, I mean, look, it ultimately, I mean, it depends on the individual, and obviously you guys would be aware of individual circumstances. But all I can say is that. And sort of to my earlier comments, when you get these sort of environments, there are sometimes markets, they overshoot, things get oversold, and one of the most dangerous things, like anything, is reacting on emotion. And as we know, fear is a powerful emotion. And if I sort of reflect back to the GFC, which you had big structural issues in the banking system, basically, and the credit, access to credit just sort of disappeared so to speak. So, but in that time, yes, you saw a lot of clients, move to cash or whatever it was. And then subsequently, the market sort of recovered and you had that recovery. So I think it's just a sort of, from my perspective, it's always thinking about, what's the broader objective and the broader goal. So as clients have their own objectives and goals, I mean, from an investment perspective, when we think about the portfolio, we also think about that and think, okay, well, what are we trying to achieve over the 3, 5, 7, whatever 7-year period? And trying to look through and look through sort of the day-to-day data and say, okay, well, what's changed, and what are the risks, and then trying to sort of, have a thought process around it. So certainly in periods of volatility, that's what helps us, is having a very clear process and building blocks. So we're looking at, okay, are asset prices expensive or cheap? What's changing in terms of the economy? Are rates going up? Are they going down? What's economic growth looking like? All of those sort of things, and having a clear framework. So, and that just helps you sort of avoid making rash or emotional responses. And so I mean, I'm trying to, without sort of directly saying, okay, but all I'll sort of say is that we've seen evidence in the past that eventually markets do recover. Periods of transition are painful, and we're in a period of transition at the moment. And that transition is effectively, if you were to break it down to its most basic element, we're moving from very low interest rates to higher interest rates, and the whole economy, households, everything is recalibrating. And that's why we're seeing the volatility. So I think just sort of, now sort of changing, unless your appetite for risk has changed in terms of your risk profile and so forth. And I know that's what, you guys have to sort of grapple with that. And it's a hard conversation because, when things are good, it's different when things are more volatile. But unless there's any sort of fundamental shift in what, and yet all your time horizon's still the same, then I think they're the things to think about, rather than sort of looking at, okay, well, gee, the last several months, 6 months has been ugly. I'm going to make a call based on that. It's one of those long, throwaway lines, but that sort of having that longer term view is important. Or it's important all the time, but certainly important when you got periods of more volatility, because as I said, there are sometimes opportunities as well in this environment. And you just need to, it's not all bad news, I think, all the time. The decision to go into cash, it's almost, okay, I'll go into cash, but then the decision is, when do you come out of cash?
Yeah. And that's a conversation we're having with a client recently, where they kind of pose that, well, should we go to cash until everything settles down, until all this bad news is out of the way? And I think a couple of things you've already echoed there, which is, well, one, the market doesn't wait for the bad news to go out of the way. It'll start to recover well before that goes away. Two, there's likely to be some more bad news coming at some point, whatever drives that, where from, more political issues around the world, and therefore the focus of that investment philosophy that unless, as you also said, which is a saying that Wayne often uses, like, unless the circumstances change, then the strategy or the philosophy shouldn't change, which is, it is, and an example is, okay, hey, Martin, I need to help my son buy a house. I need 100 grand in 6 months. Okay, well, then I think we should change something. Perhaps that shouldn't be in a direct share portfolio to that. Let's change that. So if the circumstances or the strategy have changed, then yes, the approach has got to change. But if it's, I'm 58, I'm retiring in 5 years, and I'm setting up my super for the next 30 years in my retirement, it's down by 8% in the last 12 months. What should I change? Largely not much, other than making sure we understand our investment philosophy.
No, absolutely. Yeah, you're spot on. So it's individual circumstances are key. 100%.
Yeah, I think echoing our investment philosophy, which is we use a bucket approach to ensure people have access to cash that's not in the market. And one of the key drivers we look at, which I think is only going to improve with discussions you've talked about with interest rates and bond markets, is also what's the income of the portfolio producing? Because some clients recently, using round figures, let's say they had $1 million in their investments, they want to live off $50,000 a year. If it's producing $50,000 in income and dividends and distributions and fixed interest returns, it largely doesn't matter what the value of the portfolio is, whether it's 950, $1 million, 1.1, because what it's producing is covering what they need. So they don't need to eat into the capital or access the capital. Everyone's situation is different, but for those kind of people where you've got what's coming in, what's covering going out, arguably the value of the portfolio is less significant.
Yeah.
Not everyone can be in that position, but I think if you're that as a starting point, well, then it's nearly make sure we have discussions, but tick the box and move on and be comfortable. If there is a shortfall, making sure that we've got our cash buffers in our buckets so that we don't know if the market's going to recover in 3 months, 6 months, 12 months, or 2 years, but we know at some point it will hit an all-time high again in the future. And moving to cash and waiting for the perfect time to jump back in, we know there's various charts and graphs and research that shows that that's not going to, it's good luck rather than good management kind of thing.
Yeah, it's very difficult to time it.